Hello, everyone. So, what I want to discuss today is that I believe that Warren Buffett's teachings don't hold the same weight in this day and age. So, holding stocks in the likes of Coca-Cola and consolidated businesses that did provide a great performance while these companies were expanding, but now that they're present in huge quantities in almost every country across the globe, I find it hard to justify keep holding these stocks. What I mean is this. Unilever sells their products in over 190 countries. 288 ounces servings of carbonated drinks are sold in Brazil per capita every year. Chocolate manufacturer offices in the UK exports massive amounts to Sub Saharan Africa. These FMCG companies have already been through deep cost cutting and now they're aiming to expand their revenues once again. How? Through premiumization, expecting customers to spend that extra pound for more premium products. Actually, that being said, people cannot consume more chocolate due to the obesity epidemic, right? They cannot use more shampoo than what they're currently doing. All that is left for growth is building products with better taste, smell, packaging, nutrition, that therefore can be sold at higher prices. But can you see that there is a natural ceiling to this? For instance, in the chocolate industry, you can sell normal chocolate, then better tasting chocolate through better formula, then more cocoa chocolate, such as dark chocolate, then more protein with chocolate, then low carb, then vegan, and then what? That is it. That is the natural ceiling. Now, on the other hand, let's look at the tech industry. Every company that is flourishing over the last decade has been direct tech or part tech businesses such as biotech, fintech, etc. For example, Apple every couple of years is able to release a high-priced bestseller that adds up on successful products. The new breakdown of Apple is still based on iPhone primarily, but it no longer relies either on the Mac or the iPhone alone. Actually, it has a series of products that are successful and keep building up. Google has Google Search, Google Chrome, YouTube, Google Cloud, but also keeps innovating. For instance, in AI, autonomous cars, quantum computing, so that this will generate truly incremental revenue on top of what it currently has, unlike the more consolidated, saturated industries. Also, Google can do a lot of cost cutting because it hasn't need to do as yet. More consolidated industries have gone through a lot of cost cutting already. And Warren Buffett knows this fact, right? That's why half of his public investments go to Apple. But he doesn't talk about that plainly. He still goes on never selling a share of Kraft Heinz or Coca-Cola. But the truth is, in the 21st century, most investors should put most of their time and money into technology stocks.